In this episode of the Ari Kim podcast, I'm joined by co-founder Yenwen Feng and head of content Jamie Holmes of Perpetual Protocol. Perpetual Protocol is a decentralized exchange allowing users to buy and sell perpetual futures. In short, perpetual futures let people predict whether the price of a cryptocurrency will go up or down and profit or lose based on whether their prediction is correct. Perpetual Protocol is one of the largest decentralized perpetual futures exchanges, facilitating over 18 billion in trading volume. Yenwen, Jamie, and I explore a variety of topics like what perpetual futures are, Perpetual Protocol's design, and the new automated investment strategies built on top of the protocol. It's worth mentioning that day trading should only be done with funds that people are both prepared to and willing to lose. Yenwen and Jamie, thank you two so much for joining me on the podcast today. It's a pleasure to have you two join me here.
Hi, Ari. Thanks for having us.
Perpetual Protocol is a very interesting protocol. Lots going on, lots of new things from the last year that have been built with the protocol. So I'm excited to explore those topics today. But before we jump into understanding what perpetual futures are, what the Perpetual Protocol is, let's just get you to do a quick summary of what your roles are in the space and some of your experiences. So Yenwen, do you want to start us off by sharing a little bit about yourself?
Sure. So I'm Yenwen. I'm one of the co-founder of Perpetual Protocol. We actually start from 2018, like long time ago, like before, the crash, the first crash, actually the second crash. At that time, we are really excited about, the whole smart contract you can write a trustless program. That's really new to me. I'm an engineer, so I'm really excited about that idea. So we kind of working in this area, and then DeFi. We start market in 2019, 2020. It's not that good. But still, we see some opportunities in DeFi, so we work on this perpetual future. We want to make it on-chain, trustless. So that's why we start Perpetual Protocol.
And Jamie, do you want to jump in here and share a little bit about yourself?
Yeah, sure. So I've been involved in crypto since around 2017. I got my start as a journalist / writer for crypto.news. And since then I've been involved in content creation in the crypto sector. I've had few of my articles published in a Bitcoin magazine as well, and I joined at the beginning of 2022 as a content writer, and I've just been pretty interested in trading and the kind of promise of cryptocurrency to deliver digital cash and that sort of thing, and decentralized finance. A bit late to that, but it's just really interesting to me.
Great. Before we jump into Perpetual Protocol and how it works, maybe you two could lay out exactly what futures are, and then from there we can build onto what perpetual futures are, because for those who might not be exposed to trading or the finance space, this can be a little bit of a difficult idea to wrap our heads around. So could one of you two please just share us what these futures are, and then afterwards what these perpetual futures are?
Okay, sure, yeah. So futures are basically like a derivative contract where you can claim a certain amount of a commodity or certain currency or an asset at a certain date. So futures contracts, you can get leverage with futures, and the original reason they were kind of created is to help agricultural farmers hedge against price risk, basically, so they can lock in the price for their commodities that they produce. And then perpetual futures, so not the futures have an expiry date, and then that gives rise to what is known as either contango or backwardation. So that just refers to whether the price of the futures is trading above or below the actual spot price of the asset. And then the difference with perpetual futures is that they never expire. So that's an innovation that's native to the crypto sector itself. And basically there's a mechanism, a funding rate mechanism, and that keeps the price of the perpetual future in line with the asset itself. So with normal futures, you'd get this backwardation or contango situation, but in perpetual futures, it's not really the case. So the funding rate kind of keeps that price in line with the actual underlying price of the asset that it's tracking.
Okay, so futures allow people to predict essentially the price at a certain point in time in the future that occurs between buyers and sellers. And in these perpetual futures, well, there's not actually an expiry date or a specific date and time, but instead you have people who are predicting whether the price goes down or the price goes up. And then the people, depending on whether the price goes down or up, is paying the other group of people, depending on, again, the outcome of that price difference. Okay, so let's jump into a little bit about the Perpetual Protocol. So from a high level, how does the Perpetual Protocol work?
Sure. So we Perpetual Protocol, we want to bring this like perpetual swap contract on chain. But because this is on chain, so we we want to actually minimize, the human part. So there is like in traditional like centralized exchange or like like New York Stock Exchange or all the exchange, they actually have like market makers. They have like different party that work together to actually provide that trading infrastructure. But we want to actually use smart contract to replace that. So at that time, we have like other projects like Pioneer on the spot market. So Uniswap, Curve, they build different kinds of, we call this automatic market maker, AMM, that is a smart contract. It based on a certain like math formula or like other mechanism that provide this trading feature, but without like market maker, without an other party joining. So the retail can trade against that smart contract. So for us, we did the same thing. We designed a set of automatic market maker that's suitable for perpetual future only. And in detail, it's kind of like we still use like Uniswap kind of like SYK model, but a higher level that the trader can just trade with our smart contract, so they can get this perpetual swap, like trade against with each other. So that's what we provide.
Great. So let's just go into that point a little bit more detail. So just to clarify for our listeners, there are centralized and decentralized platforms that allow people to buy and sell these perpetual futures. And in the case of Perpetual Protocol, it's a decentralized way, meaning it solely relies on the execution of smart contracts. Now, if you two could outline what are the advantages of having a decentralized exchange for perpetual protocols as opposed to a centralized platform like Binance, for example?
Yeah, I think one of the big issues with centralized exchanges is like transparency. So with like on-chain derivatives like Perpetual Protocol, everything's happening on chain, so there's extra transparency there. Whereas with exchanges, it's kind of like you're not too sure like what's happening behind the scenes. So yeah, there's like a lot of chatter amongst traders around like are centralized exchanges like hunting your stop losses, or do they know your liquidation prices, and are they moving the market in a way where it's negatively affecting their customers? So that's one of the main advantages of like decentralized exchanges, because they're on the blockchain, and it's like everything's out in the open and you can see what's going on, and then in theory that should like reduce market manipulation and these kind of like predatory practices against their customers. And then another thing as well is like community ownership as well. So a lot of like decentralized exchanges and DeFi projects that are on chain, they share like the revenue with the token holder. So with Perpetual Protocol, anyone that holds like the perp token can claim a percentage of the fees that are generated by the protocol. So it's more of like an open model for anyone to kind of like get involved as well and actually benefit from the revenue generated by the exchange. Whereas with centralized exchanges, it's like it's like a purely private company, and profits only going to like a small group of people. Yeah, is there anything else you wanted to add on to that, Yenwen?
Yeah, I would say the transparency definitely is the key. Like you actually get a lot of questions like, what happened? I mean, like inside a central exchange or like New York Stock Exchange. I mean, what happened? Like I can actually make an offer. I want to buy an Amazon stock at like like 200 USD. How do we know that there are actually other people who buy? Like because he can see my order, and then he actually go ahead and then buy like another order at 199 and then sell me at 200 and then actually make a small profit. That if they do this at every order, they make a huge profit, right? So how do we make sure that they are not doing that? I mean, in traditional finance, there are regulations. So you can, I mean, like, like if you want to have, like create and change, you have to pass through all the regulation, everything, but it doesn't really catch all the, like insider trades or everything. But we can actually make it better. We just build it on chain. Everyone sees everything. So even if there are people want to do insider trades, we see everything. There is no inside outside because we see all the trades. So I think that's definitely the like much better than the traditional way.
Mm-hmm. And the numbers don't lie. I know that Perpetual Protocol has facilitated, I believe now, $18 billion in perpetual contracts, and that's an extraordinarily a large amount of money, and speaks to exactly that point, right? This demand for transparency, this demand for people to really know, in fact, what's happening with their funds, and that's again leverage the use of this open source, open transparency of blockchain. So there are trade-offs when we have these decentralized exchanges compared to the centralized one. So what are some of the risks or trade-offs from this design compared to those of centralized ones?
So this decentralized ones, I mean, definitely, I mean, the advantage we talk about transparency, trust us, because I mean, the smart contract is not run by a perpetual team. It's actually run by a group of nodes on Ethereum blockchain. So I mean, like, it's also like you don't need to trust us. You just trust the blockchain. Everything should be automatic. So that's also an advantage. They are like like trusted permissionless. Everyone can access. You don't need like you don't need to be like U.S. citizen to invest in Amazon stock or like to use the New York Stock Exchange service, right? So those are the advantage on the blockchain. But also like is because it's unregulated. I don't know if regulation really help, but anyway, it's unregulated. So there are actually a lot of scam. There are like there are many hacks. To be honest, like it's still early. I mean the whole system is not mature enough. So there are many hacks that happens. Like people, I mean, get away with millions of dollars. You might got hurt. But I think that's also the same. Like maybe like 100 years, 200 years ago, on the traditional finance system that we first like established. I think there are also like lots of this kind of problem. But as like a system become much more and more mature, I think this problem should be able to be solved. I mean, by like project working together. Yeah.
Jamie, you want to jump in there?
Yeah, I was just going to say, like, I think with the centralized versus decentralized exchanges, there is like a different kind of risk for each one. So centralized exchanges like solvency risk and then counterparty risk, like like I mentioned earlier, is the exchange trading against you, and are they liquid enough to pay out your deposits if everyone wants to withdraw? But then with decentralized exchanges, that risk is not really there, but then there's like smart contract risk. So is there a possibility of a bug or an exploit? But then to get around that, I suppose like a lot of projects in DeFi do like audits as well. So Perpetual Protocol's gone through many audits. So that's kind of like a way to address that kind of risk.
Yeah, and I think to the point that you were saying, Yenwen, there has been continuous hacks in the decentralized finance space. Up until recently, Euler was hacked, I believe, in March or April. and that was, again, tens of millions of dollars. So hopefully this is an issue that's solved through the maturity of the space. The longer the code's out for, the more robust it is, the less likely it is to be hacked. So I'm sure that as time progresses, right, these issues will begin to fade with time, at least hopefully. I want to just briefly talk about the virtual automated market maker, the one that Yenwen had referenced earlier, because I think this is, well, firstly, this is an essential part to understand how Perpetual Protocol works. But it's a little bit difficult to understand. Even an automated market maker in itself can be a little bit of a challenge to wrap your head around. So, Jamie, if you want to start off by explaining what an automated market maker is, and then how this virtual automated market maker actually makes it a different sort of system for the Perpetual Protocol.
Okay, sure, yeah. So automated market makers, I think the easiest way to understand it is, instead of like an order book model where you have makers come in and provide liquidity at certain prices, an automated market maker, basically you have two pools of different assets. So, ETH and USDC, for example. And when traders want to trade between the two, the amount that you get, that you will receive, is kind of calculated by like an equation. So the X times Y equals K equation is like well known, and it's like kind of like the base of automated market makers. And then so it's basically acting like a trading engine, like a pricing engine. So if you wanted like 10 ETH, and then depending on how much ETH and USDC is in the pool, you'll be supplying USDC to the pool, and then you'll be removing some ETH from the pool, and then basically depending on the amount you're putting in and or the amount you're taking out, it gives you a certain price depending on that. And then so liquidity is provided by makers, and then the more liquidity they provide, then the more liquid the market is, and then the less price impact there is, so people can buy more and more ETH without moving the price too much. And then so that's like kind of a bit of an overview of like the basic sort of model. But then we're getting sort of you introduced like makers, so you had actually like a different kind of, like you're still using that same equation, but you have you could place your liquidity in ranges instead of across the whole curve. So they can increase their fees, and you can take directional views on the market as a maker as well.
Interesting. So actually, as someone who wants to provide funds or liquidity to the platform, you can put it within a specific range of the price to essentially get a certain amount of return. That's, again, this market that you're speaking of. Is that correct?
Yeah, exactly. So with so it's termed like concentrated liquidity, and then the benefit for makers is that they can get like a higher share of the fees. So then it kind of becomes like a similar competition as it is with order books. But then because on an order book, a maker might place some liquidity at a certain price to another, might come in and like kind of undercut then. So, but then with AMM, it's a bit fairer as well, because anyone who's placed liquidity within a certain range and whose traders trading within that range, everyone's gonna earn fees, but it depends, their proportion depends on basically their range and how much liquidity they're provided. So in an order book, it's kind of like winner takes all, but then on an AMM for the liquidity providers, it's kind of like that's not the case. It's like it's basically pro rata or proportion to their range and to the liquidity they provide.
Mm. And for people using the platform, are people typically trading perpetual futures of Bitcoin, Ethereum, or is there any interesting trends currently within the market in terms of which tokens are people taking out these contracts for?
For us, actually, I think like close like all like most of the decentralized like perpetual swap platforms, ETH is still the most traded token. So most of people they trade ETH market. And the next group of tokens, I think, is more like platform specific tokens. Like for example, we are on Optimism, so we are on a layer 2 platform. So OP is definitely one of the tokens that most traded. On our exchange, and also like on our competitor Synthetics, they're on OP as well. But if you look at like other platform, I mean other layer twos or other blockchains, they might trade different, I mean tokens. But I would say like ETH still maybe like took like over 50% of the market.
And so you mentioned there OP or optimism, right? And this is a layer 2 scaling solution. Layer 2 scaling solution I find to be a total mouthful. I think people hear the words layer 2 scaling solutions and they turn their ear off. So let's start. If you could actually just briefly explain what optimism is and then explain why you chose to use this scaling solution as opposed to some others on the market. I know Arbitrum is a popular one. So yeah, if you could lay that out for us.
Sure. So let me go first. Ethereum so actually there are many blockchains out there, like you have Bitcoin, Ethereum. Ethereum is the first one that come out with, like a really good design of smart contracts. So that's why a lot of people like building protocols is on top of Ethereum. But Ethereum has this like issue that, when you design, it's actually back in like 2016. So, the bandwidth of that blockchain, are kind of like easily like filled because a lot of people pay attention, a lot of people want to trade like NFT, DeFi, a lot of things. So how they handle this is that so our throughput maybe like like 100 transactions per 10 seconds. If there are lots of people really want to send transaction, we just charge more. So they use a unit called gas. So just like just like a gasoline that putting on in car. So the gas is there is a price for that. So if you want to send your transaction that execute faster than others, you should pay more gas. And then the gas just should goes high like 10x, like 100x like over the time. And then in the end, if you want to send a transaction on ETH mainnet, I think the highest is like $100 per transaction. Depends on how you do, but $100, which makes it definitely not usable. So that's actually go back to so they see the problem. They want to actually create another system. They call this like a layer system. So you have like layer one is Ethereum, and then they create another. They call this like layer two. So layer two is like it kind of like overload all the computation onto another layer. So layer two do the computations. Like make sure that all the transactions got executed right, and then they upload the result back to layer one, so they can aggregate a lot of transactions into a smaller one and then upload. So the smaller one take less gas. There are many technologies to do this, but the most mature one is Arbitrum and Arpinson. So they are both using this technology called administrative rollup. So this rollup means that they just aggregate a lot of transactions on layer two, and then every like several minutes they upload to layer one to make sure that all the transactions got executed right. So, and because they do this compression like upload thing, so each transaction actually costs maybe like 10x or like 50x less than layer one, than Ethereum. So that's why they want to have layer two, and then how it works out.
Jamie, do you want to add on anything to that?
Yeah, I think the way to think about it is like a blockchain built on top of a blockchain. So optimism and layer two solutions are like built on top of Ethereum and just like enabling greater scalability. So yeah, there's like a lot of different layer two solutions out there, and they all kind of like differ slightly in the mechanism that they use and like how they prove transactions are valid and that sort of thing. But yeah, I think the easiest kind of way to understand it is like an add-on to the Ethereum blockchain, which is a lot cheaper and provides more throughput and faster transaction times.
Yeah, I recall having Nenad from DeFi Savers, the co-founder of DeFi Saver, on the podcast as a one-stop dashboard for managing DeFi positions. And I recall that one of the things they'd recently implemented was Optimism and Arbitrum. And I believe that the number of people who were using the dashboard increased quite a bit with the release of those L2s. So I suspect that these layer 2s, have already, but will continue to actually onboard more adoption, or at least save people a whole lot of money when it comes to some of these gas fees, right? These fees for interacting with the blockchain. So I know that, as we were referencing earlier, Perpetual has some new features to it, some of which include Lazy River, Smart Maker, and the Hot Tub, all excellent names, I have to say. And those actually threw me off quite a little bit when I was initially doing my research. So I think it'd be very beneficial if you two could lay out how each of these work one by one, and then we can go from there.
Okay, yeah, I can start with hot tub vaults. So the hot tub vaults are like a new product that we've introduced recently, and it's kind of geared more towards like passive traders, or less sophisticated traders that don't want to like deal with strategies and probabilities and statistics. So basically what these vaults do is execute like an automated strategy for people, and what it does is it does arbitrage between virtual futures markets on Perp and then the spot markets on like Uniswap and other decentralized exchanges on Optimism. So the reason why we're offering these vaults and is because basically it's just given away for, it's just like expanding our audience basically. So perpetual futures is kind of like, can be seen as like complicated, and it's not everyone's like cup of tea. Not everyone wants to take leverage trades, but hot tub vaults, they can basically benefit from an arbitrage strategy. And yeah, because this strategy is like lower risk, and it's a high reward, it's high rewards as well. So there's not a lot of risk in the strategy because it's always hedged. So there's like, it doesn't really matter about the price movement of the underlying asset. And then for each market, we have two separate vaults. So for the Ethereum market, for example, there's an ETH vault and then the USDC vault. So people can choose which one they want to deposit. So someone that's bullish on ETH, they can just deposit some ETH into the vault, and then they'll be only a return in ETH from arbitrage in the market. And then if they're a bit more conservative, then they could just hold stable coins, but then still kind of capitalize on the volatility in ETH by depositing USDC into that vault to earn more USDC. So yeah, it's basically like democratizing like arbitrage for the normal kind of general audience, whereas usually that kind of strategy is usually executed by like institutions or really like more sophisticated traders. So it's really about like simplifying these sophisticated on-chain strategies and making them easy for people to use, and then like packaging them into a vault. So yeah, so people can earn like decent yields from like a sustainable strategy as well, because crypto is going to be volatile for the foreseeable future. So arbitrage is going to be profitable for the foreseeable future as well.
So I'm curious, how much are people typically making in APY or interest?
I think in general, it depends on the market. So we have ETH market, we have we have OP and USDC. I think in general on ETH market we have around like 10% like APY. 10 to 20. So on the OP, I think we have around 10. On USDC, we have like maybe like 5 to 10 around there. So I would say it's a good like APY overall. So that's what we have now. So I think like we will add more markets. So different markets just have different conditions, so it might differ. But this also, like if you want to deposit into this vault, you will not be locked. So anytime you want, you can withdraw right away. So there is nothing stop you like putting deposit or withdraw.
Nice. And let's jump into Lazy River 2.0 for a moment here. So do you want to explain a little bit more about that?
Yeah, sure. So I mentioned before, like community ownership is kind of like a benefit of decentralized exchanges, and that's kind of Perpetual Protocol's like angle on community ownership, is where any of the token holders can lock their tokens and earn a share of the platform's trading fees. So currently, 15% of the trading fees generated are directed to token holders. So every week, and if you hold vote escrowed PERP, which is basically locked PERP, you can actually get a share of those trading fees. So that model is really inspired by Curve, like Curve's tokenomics. So that's the project that originated VE tokenomics or vote escrow tokenomics. So with Curve, you can lock up your Curve for up to 4 years, and the longer you lock up, the more VE Curve you get, and then the more rewards and benefits you get. And then with PERP, it's similar. That instead of 4 years, the maximum lock time is 1 year. So if you think about two people, if they have the same balance of PERP, then one guy locks it for 6 months, but then the other guy locks it for a year. The guy that locks it for a year will get like double the rewards as compared to the other guy, because he's shown like more commitment to the protocol and he's locking his tokens for longer. So it's kind of like to incentivize people to lock up their tokens and really like align the interests of the token holders with the success of the project. Because if you're earning the share of the fees, then you've got an incentive then to like kind of like promote the exchange and make sure it's like you can ask people to use the exchange and like add more volume, for example. So the more volume it's doing, then the better it is for all token holders overall. So it's kind of just like linking the incentives there.
Cool. And for these 15% fees that have been paid to people who are providing their PERP or PERP tokens, right, that can be purchased on an exchange, how much in fees have actually been given so far from Perpetual?
It's almost $1 million. I think the last time I checked, it was just over $900,000 it's been distributed to token holders. So I think that's in less than a year as well. So I think in annual terms, it'd be about 1.4 million, 1.5 million, something like that.
Okay, so let's talk about the very last piece here, which is the smart maker. So do you guys want to explain a little bit about that?
Sure. So the smart maker is another system that we built. So in simple term, we want to actually bridge the liquidity on centralized exchange to decentralized exchange. Binance is still like the exchange that holds most of the liquidity. So we actually figure out a way that if like a retail want to open a long position on PERP, on our PERP exchange. So we see that order, like for example, like he or she want to long like 1 ETH on PERP exchange. We can actually look at like Binance, like how much what's the price they can provide for 1 ETH loan. If we found out, actually the price is actually better than us, we can kind of like open one loan on Binance, and then we sell the loan to the user, and by actually JIT ourselves. JIT is just in-time liquidity, so we can kind of provide liquidity within a block. So that's just technical term, but we are able to do that technically, so that user get the better price. So that's just a way that we want to actually provide better price to the user. So just like a different way that we can do. Yeah. So this is smart maker. By introduce this, I think for each market it's actually okay. Because like on each market, Perpetual Protocol, ourselves, we already have like enough liquidity for trades that people normally trade. But for like more like altcoin, like smaller cap tokens on PERP exchange, this mechanism actually help a lot. Yeah. So that's also like something we just launched.
Great. Yeah, that's exciting. It's always exciting to see people within the industry, builders like yourself, adding on top of existing projects, innovating them and making them new to some of the most current trends within the space. Uniswap v3, for example, being one of them. Although it's been around for a few years now, it's simply not the same as what Uniswap v1 is, and that's, I think, something beautiful about the decentralized finance space more generally. It's just this incentive to innovate and build better systems in an open and transparent way. And I think that's something that you don't normally see in traditional finance, or at least to the same degree. I think that my checking account, the savings account, is very different from my MetaMask wallet or whatever wallet provider that you choose to use. And I think that's a very interesting piece of the puzzle. Okay, so before we end the podcast today, I want to ask you if there's any other things that are lined up in the upcoming future for Perpetual Protocol.
Yeah, sure. So I will take this one. We actually have like something I think that's interesting. Okay, so let's take a step back. So we already have a good foundation. I mean, on the Perpetual Protocol itself. I mean, so we implement most of the. I think we are the most feature complete, like perpetual swap projects in the market. So right now we are more focused on like how we can actually make it more efficient. I mean, and also how we can bring more liquidity to the platform. Also, like, can we build, we have built our top, we have this smart maker. Can we actually build more strategy? I mean, like Perpetual Protocol platform. So that's the thing we are working on. So definitely want to, I mean, like we will have like more like votes like hot top for sure. And also like other kind of, just like smart maker is one of the strategy. So want to have even more like strategy on the maker side so that people either easily can provide liquidity or ourselves we can like smart maker we can actually bring liquidity from other places onto this platform so that taker always get a better price. So that's I mean, like in short, I think that's like the thing we are working on right now.
Great, exciting. Yeah, I'm looking forward to seeing some of those new investment strategies, new arbitrage opportunities. It's a growing space, it's a new space, and I'm sure there'll be a lot more to innovate on in upcoming years. Thank you too for joining me on the podcast today. It was a pleasure to learn a little bit more about day trading, how the Perpetual Protocol works, how in fact these perpetual futures exist in the first place. So it was really a wonderful opportunity for me. Thanks so much for joining me.
Yeah, thanks for having us.
Yeah, thanks. Glad to be here. Thanks.
Thank you for listening to this episode of the Ari Kim podcast. Please consider supporting it through the Make a Contribution button or the wallet address found in the video's description.